good morning to all, and very welcome to a review of the third quarter events in the financial markets. I think it is just appropriate to start with a review of some of the macro events that drove financial prices over the last quarter. I think none of the news is probably new to everybody, but we know that it almost seems as if the war in the Ukraine doesn't want to end. We also have seen that the Chinese government has continued with quite an aggressive political stance against the Western world. And then, of course, in 10 Downing Street, we've also seen that the doors continue to revolve. And finally, from a financial perspective, we have encountered double-digit inflation numbers in many parts of the world, particularly in Europe, where the inflation numbers were above 10%, in the US, inflation of over 8%, and even in South Africa, where the inflation numbers spiked to 7.5%. With that as a background, of course, at the beginning of August, we had the Fed speech delivered by the chairman, Jerome Powell, where he's given a very hawkish message. In other words, a message where he said that his biggest enemy, or the Fed's biggest enemy, in fact, is inflation, and they're going to target inflation to bring it back under control, closer to the 2.5% level. That is a sustainable level for the US. As a result, we've seen another spike in interest rates, where for the third time we've seen a 75 basis point hike in interest rates in the United States. With that as a background, it is very easy to understand that financial asset prices were under extreme pressure in the quarter. So if one looks at global equities, that came back with about 6.5%, and even global bonds retreated by about 7% in the quarter. If we look at the year-to-date numbers, we've seen that US equities are down by about 20%, and if we look at the tech sector, as represented by the NASDAQ performance, that is down 30% for the year. In South Africa, equity markets are down by about 11% year-to-date. So all in all, to summarize, in financial markets, there were really no place to hide. And about the only sector that produced positive returns was the oil sector, where the oil price is still up on a year-to-date basis, and shares or assets that are related to the oil price were higher. And finally, of course, money was protected, certainly from a nominal perspective, if you had it invested in cash. But of course, cash didn't protect you against the inflation rate. So with that as a background, of course, the question is, what do we expect to happen in the next quarter or in the next part of the investment cycle as we see it? And I think, one must just understand, when you discuss the future, there are two things that have an impact on financial assets. The first thing is the change in investor sentiment. So what does it mean in simple English? What does it mean when sentiment changes? It means that if sentiment changes, investors are prepared to either pay more for the same asset if the mood is positive, or investors are prepared to pay less for assets if the mood turns sour. And that is the trick with financial markets, is that it is impossible to forecast how investor sentiment is likely to change. And that was the main reason why we've seen the massive volatility that we've experienced in the third quarter, is that when the market changed its views on how the Fed will implement monetary policy, the mood changed for the negative, and we had very aggressive sell-off in the latter part of the quarter. So I think if we think that the recent history is likely to repeat itself in the near-term future, it is important that we should think about what can change the investor sentiment in the world across the entire spectrum of asset classes. And I think, just as interest rates were probably the most important thing to look at in the last 9 months, our view is that that will also be the most important financial variable that we should try and get a handle on. So let's just explore that particular area. What is the most important thing that will drive interest rates? Of course, at the moment, we think it is inflation. So if you get positive surprises on inflation, in other words, if inflation is lower, one can expect the Fed to have a more dovish or more relaxed monetary approach when they decide on interest rate policy. Of course, the opposite is also true. If inflation numbers are higher than what the market expected, then of course one can expect the Fed to continue with the hawkish or aggressive approach that they've been applying over the last 6 months or so. And I think the next two meetings of the Fed is going to be the important ones. In the next week, we are likely to see the first meeting, and the market expects a 75 basis point hike in that meeting. At the moment, the market is pricing in a 75 basis point hike in December. And of course, if macroeconomic numbers would suggest that we are not going to see 75 basis point hike in December, but more, then we can expect financial assets to remain under pressure. That includes equities as well as bonds. The opposite again would be true. If economic numbers are weaker from a growth perspective and inflation numbers are lower, then the Fed is likely to be more relaxed in their approach. And we might not see 75 basis points, but a 50 basis points hike. If we see that, we think that both the bond markets and equity markets can respond aggressively with a nice spike in those prices. So it's all at the moment, given the massive amount of uncertainty in the markets, it's all data dependent. And therefore we think that in the short term, clients must use the cliche, tighten their seatbelts, because we might well be in for another round of quite volatile markets until it becomes clear that the Fed is winning the battle against inflation and that the interest rates can come off, and then hopefully the market will look through in terms of economic growth, and the lower interest rates will boost growth in the latter parts of 2023. So that is really what we need to focus on. So if we put that on the side burner and look at valuation, which is always normally our starting point when we look at the prospective performance of the different asset classes, the one thing that we can say is, because the markets, both bonds and equities, sold off significantly, as I mentioned earlier in the discussion, one would almost be naturally inclined to say, well, the valuations must be cheaper. And if valuations are cheaper, then maybe this is a wonderful opportunity to acquire these assets, because we've always maintained that you want to buy when prices are low and sell when prices are high. I think given the uncertainty that we've seen, one, as I've explained, but also the fact that the starting point of asset prices and equities and bonds, both of them, the starting point, if you go back to November last year, was quite high. So despite the aggressive sell-off in both asset classes, these asset prices, when we look at it now, is back on the long-term trend valuations. So they are not cheap yet. They are cheap on a price-earnings multiple, simply because the prices have come off and the earnings is still quite strong of companies in general. So on a price-earnings multiple, they look cheap. But if you simply look at it relative to the longer-term trend, and that trend we take back to 1960, they are back on trend, and that gives us comfort. But it's certainly still not what we would call a dripping roast or very, very attractive from a valuation perspective. So with that as a background, when we position portfolios, we still think it is quite appropriate to apply a conservative approach in the positioning of our multi-asset portfolios. What does a conservative approach mean? It doesn't mean to say that as a result of the uncertainty, we need to sell these assets now. We have already sold equities down in 3 lots over the last 18 months. So we have been positioned for the more negative scenario, which we think is correct. So we now sit on the equity side with a neutral position, and we don't think it is now an opportune time to add. We are not underweight. So if the market goes up, our clients' portfolios are exposed to the equity market, but not in an aggressive way. So we think we are correctly positioned for that. The massive sell-off that we've seen in bonds, we think it actually provides an opportunity. For 6 years, we've been very negative about the prospects for global bonds, because you can recall that those yields were almost flat, and it just didn't present a decent opportunity for us. The sell-off in bonds, which means that yields went up, provides a wonderful opportunity now, because those long bond yields in the States, they are now trading at about 4%. So if you buy a long bond and you hold it until maturity, which is, let's say, 10 years in this case, your yield to maturity will be 4%. If inflation comes down to 2.5%, then it means on average you will get a real return of 1.5% over that period. So it was an asset class that we completely ignored. And this weakness in this asset class now, late in the third quarter, early in the fourth quarter, we've used the opportunity to increase the exposure in our multi-asset portfolios to that particular asset class. And we think we will reap the rewards over time. I think the last point that I would like to make, and I refer to the investment clock often in the past, because as the investment cycle progresses, there are normally asset classes perform in a particular way depending on which stage of the investment cycle we are in. And what we have learned that should you go into recession, then bonds is normally the asset class that perform the best. That is the security or the safe haven asset class in our portfolios. And as a result of that, with the fact that the prices are looking much more attractive than any time over the last 6 years, we've actually added to bonds, and we think that is the correct asset class to add to the portfolio, given how we see the investment cycle, but also from a valuation perspective. So I would like to conclude. I don't think the uncertainty will change, but unlike if you're a physicist, there's a physicist called Richard Feynman. He said, imagine how much harder physics would be if electrons had feelings. Now, investors have got feelings, and we call that sentiment. And I think the investment sentiment that we've seen in the third quarter that was quite negative, that can easily change should the data be positive surprises. And then we can easily see a big bounce in some of these asset classes should the Fed be more relaxed in terms of their monetary policy that they would like to institute. However, the opposite is also true. So a conservative position is a position that we think that will work. I think I also need to say one or two things about the South African market. You know, I don't think it is any news that our economy struggles with well-documented problems. For this year, we probably will get an economic growth rate of 1.5%, which is certainly not enough given the demands on the economy. Nevertheless, if you look at the South African equity market, it is trading at extremely low valuation levels. The price earnings multiple sitting below 10 times, and we still favor that within the equity component to have an overweight in South African equities relative to the overseas equities. Then if we also touch on the bond side on South Africa, I spoke about the US yields that are currently, for 10-year bonds, that are currently trading at about 4%. In South Africa, it's closer to 11.5%. So that for us is quite attractive. If inflation comes under control in South Africa, we think there's enough scope for those yields to come back. And of course, lower yields mean higher capital appreciation. And one can easily, over the next 3 years, if you don't have a fiscal collapse in South Africa, one can easily expect a mid-double-digit numbers as prospective returns from bonds in South Africa. So, to conclude, uncertainty will prevail. And with uncertainty, volatility is likely to be with us. But we are now certainly seeing that the negative sentiments, that sentiment that we've experienced in the third quarter is creating buying opportunities in some asset classes. And in fact, if equities sell off, should the macroeconomic data disappoint, it will provide us with an opportunity to change our conservative position in equities into a more aggressive one where we can acquire good quality assets at decent prices.